Kia ora everyone, good morning and welcome to the RETHINK webinar series. I've got my webinar waistcoat on and my tartan eye patch as to try and make this a colourful presentation because we're talking about tax and that can always be a bit of a challenge. My name's Ian Craig, I'm BDO's eye on tax for obvious reasons. And I'm joined today by my great friend Mark Lauder from our Christchurch office, who's our National Head of Tax. Mark, do you want to say hello?
Morning. I'm also going for colour and wearing my deck chair shirt. Back to you, Ian.
Yes, you always have a different taste in clothes to me. Christina, would you like to put me on to the next slide, please? So today is about rethinking your tax. And, you know, there's an old saying in tax that there is two certainties in life, death and taxes. But I would always say there's three things, three certainties, death, taxes, and changes to tax. And today is a chance for us to touch base again on what has been happening and what's been going on in the tax world. Now, for those who don't know, there's been a new tax bill that has been enacted called the ARFER bill, or ARFERM. And for those who know that I've got a strong love of Jaguar cars, that when I talk about the ARFER bill, they think I'm talking about the great Arthur Daly, who was a well-known TV personality who drove around in Jaguar cars. But I'm actually talking about the taxation, annual rates, feasibility, expenditure, and remedial matters bill, which received royal assent and became an act on the 30th of March 2021. Now, the reason I'm putting this slide up is that this bill actually started its life back in June 2020. So it was a long period of gestation. And it's easy to forget that there are things in there that were announced last year, which have kind of fallen into the background as we focused on new matters that have been introduced through supplementary order papers, in particular the new land rules and the loss carry forward rules. So included in this bill is some helpful amendments to feasibility expenditure. This is about giving you a deduction if you undertake a sort of research into a particular project and then abandon that project before an item of depreciable property or deduction has been achieved. This is another attempt at trying to reduce the number of items of black hole expenditure, which are, you know, is an abhorrent non-deductible expense to anybody who's in business. So it gives a 5-year deduction over for any expenditure where you've abandoned a feasibility project. Also is a provision that will apply from 1 July 2021, where if you're entering into a sale and purchase agreement for the purchase of business assets, so not shares in a company, but an asset acquisition, there is going to be strong emphasis on encouraging the vendor and the purchaser to reach agreement on the purchase price allocation for the consideration paid for those assets. Now that might seem fairly innocuous, but there's been plenty of cases where a vendor might have said that they've sold their business assets for a huge amount of money and that all of it was attributable to, I don't know, the land or attributable to goodwill, which doesn't create a taxable event. But the purchaser might want to say, well, actually, I thought most of the purchase price was paid for the items of plant and equipment or trading stock or the building, with a view to getting a form of deduction. So there is provisions in here that will apply to future sale and purchase agreements that are entered into after 1 July 2021 to provide certainty of purpose, so there's no asymmetry or no different treatment between the vendor and the purchaser. And of course, if you don't reach agreement in the sale and purchase agreement, then you're going to end up with there's some provisions there as to who can notify the commissioner first and get their case in ahead of time. So that's not what we're going to talk about today, we're not going to feature on some of those other remedial provisions in there, but just be aware that that ARFR bill is in place. So today our agenda is going to be, and Christina, can you just go to the next slide, please? Yeah, so what we're going to go through today is Mark is going to recap on what you can and can't do in relation to any reaction to the new tax rate, personal tax rate of 39%. I'm then going to go spend a little bit more detail on the new same business test for carrying forward of losses. I'll then hand it back to Mark for the tax on residential properties and the changes that were recently announced. And finally, if we've got time, we will touch base on the budget 2021 with some thoughts on how they should rethink that budget, and take time to answer questions that you have posted. So if you are posting questions or would like things that we haven't covered, or you've got some questions as we go through, what we'd like you to do is use the chat facility in the webinar and post that question up, and then we'll try and keep some time aside to answer those questions. So I'll now hand over to Mark on the 39% rethink.
Thanks, Ian. I'm a bit disappointed you didn't do your French comment, so I'm going to start with a bonjour, which as an Englishman is about the extent of my French. So we'll leave it at that and move on to the next slide, please, Christina.
I practiced it, Mark, but I just didn't think it was good enough.
Oh, I thought it was. I liked it, but anyway. Okay, 39% rethink. We went through this a lot in our last rethink webinar, episode 6, I think it might have been, and we're not going to go through all the same stuff again. For anyone who might not be sure, while the guy in the picture does have some fairly decent bushy eyebrows, it isn't me. I actually think mine are better. They are a bit more bushier. But the purpose of using that rearview mirror is just again to highlight Inland Revenue's ability to use hindsight and capture things after the event. So look, I started off thinking about this one, thinking that there's a it's almost a fairly negative discussion. It's hard to talk about a 39% tax rate in the positive when we hadn't had one for a long time. In the lead up to 1st of April, there were lots of things that we were thinking about and were liking to do. Accelerate a dividend. We talked about restructuring personal ownership to trust ownership. We talked about paying less. So should we reduce salaries? We talked about paying more. Should we increase salaries? And we also talked about accelerating and decelerating. So should we accelerate bonuses? Should we look to decelerate expenditure? Should we look to try and move income to an earlier tax year? And the question is are we concerned about these things? We asked Inland Revenue for guidance, and we received guidance focusing on that so-called bad behaviour. So from Inland Revenue's perspective, we've had public statements, we had the webinar organised by CANS, and we've had various revenue alerts reminding us of certain things. Now, the big thing though, just going back to what the Inland Revenue said in their webinar, is that it is very difficult for them to be very certain in what they do and don't like. We've got to be really careful here that we don't go down a spectrum of we can't actually do anything because it's all avoidance. But it's more about what's unusual. Have your behaviours changed? Have your patterns changed? So if we look at the acceleration of a dividend, so we were all running around. Sorry, we can go. Christina, we can stay on that slide, please. Sorry, I'll keep going while we go back to that other slide. So if we're looking at accelerating a dividend to be paid on or before 31st of March, would we have a problem with this? I don't think so. Christina, you can go back to the slide that talks about 39%. Thank you. We don't have a problem with the payment of dividends prior to or on the 31st of March 2021 per se. Let's not forget we did a lot of this when the imputation ratio changes occurred back in 2008-9 and then again in 11-12. This was largely encouraged, transitional rules applied to allow us to use an imputation ratio higher than that would otherwise be permitted under the new ratio change. So paying a dividend, but what wouldn't necessarily be treated as good behaviour would be to wait until the end of the year and then start preparing your dividends and your documentation and looking to do it after the event. We're not naive enough to think that that doesn't happen, but it needs to be acknowledged that this is something that if you haven't paid your dividend on or before the 31st of March 2021, you could be running into some problems. We do often get the question of, look, we're looking at what isn't normal or changes to behaviours. So if you ask yourself the question, what if I have a company that hasn't paid a dividend for 10 years because they really did not want to pay the 5% top up? So they're pregnant with retained earnings and imputation credits. Do we have a problem with paying a dividend now before the 31st of March 2021? And the answer is no, I don't think so. It might not be in line with behaviour of the past, but I don't see that as being bad behaviour. In particular, I would have thought that the Treasury, etc., would have been expecting and anticipating a large inflow of funds from the payment of dividends and the 5% top up through the resident withholding tax. Therefore, this is a good thing, giving people a bit of time to prepare and pay a dividend that would have otherwise stayed locked up in the company. Restructuring to trust ownership. I struggle with this one, and Inland Revenue in their webinar were fairly reluctant to give too much information in this regard, but they did offer up, if you restructured to trust ownership but had contemplated this in the past but had just not implemented, then they were less likely to have a problem. It does beg the question to my mind, if I set up a new company with a trust ownership from the outset as compared to an existing company that moves from personal to trust, why is one worse than the other or more likely to fall foul of avoidance? It doesn't quite make sense to me. But I think with all these trust restructures, if you're working through trust restructuring, you need to be very, very mindful of your reasons for doing so and have documented accordingly. So that would be the thing I would do so first. What are you doing it for? Asset protection, succession planning, so on and so forth. Reducing salaries. This is one going forward is going to be hot topic. Inland Revenue's all over it. The only thing I can think of is my immediate reaction is if you're looking to reduce the salary as idea. There are two avenues the revenue can pursue here. We have our specific anti-avoidance legislation, which refers to the general attribution rules. So personal service providers interposing a company between themselves and their customer, you aren't able to shelter at the corporate level. So at the extreme, you'd pay yourself no salary, leave everything in the company, and pay tax at 28 cents in the dollar. So general attribution rule, quite specific, talks about we've got our 80% thresholds before it applies. So 80% of the income is derived from that personal service provider and 80% of the income is derived from a single source. And fundamentally, you don't really have any business assets or you don't have substantial business assets to drive the income. In that situation, the income of the interposed entity, company or trust, whichever it may be, is effectively deemed to be derived by the personal service provider and taxed in that person's name. So reducing a salary may not do anything in that regard if you're caught by the general attribution rules in any event. The other test that we hear about all the time is the Penny and Hooper, which went through all the courts. Massive argument, Commissioner 1. Under Penny and Hooper, it's under our general anti-avoidance legislation, isn't as objective as the general attribution rules and therefore, in theory, easier for the Inland Revenue to apply due to its subjective nature. These rules will look again at the personal service provider and the interposition of a company or a trust or another entity between that personal service provider and its end customers. It doesn't focus on an 80% test. It's more around personal exertion and the concept that if you roll your sleeves up, you should be rewarded accordingly. You can't shelter at a lower rate in another entity, i.e. a trust, and then use that trust to perhaps funnel income through to beneficiaries at lower marginal rates. As a default position, Inland Revenue ironically uses another 80% rule, such that they do expect to see at least 80% of total distributions from that interposed entity to find its way into the hands of the personal service provider. So effectively looking at whether or not 80% of the profits find their way into the personal service provider's hands and are taxed in that personal service provider's name, the controlling person. If it's less than 80%, then they're more likely to take offence and apply a high degree of scrutiny. There are some mitigating factors, such as a decline in profitability or a future expected decline in profitability. You may have some capital commitments coming forward, which would therefore result in that 80% being dropped to a lower amount. But if you're under that 80%, Inland Revenue have clearly signalled that they are likely to take a high degree of interest in this regard. Pay more. This is another good one. You ask yourself the question, why do we have a lot of people in New Zealand that seem to earn $70,000? Well, they do, because that's when the marginal rate changes. So there is a tendency for, again, close companies, sole traders, partnerships, clever tax planning. What we'll do is we'll pay a spouse or a relative an amount and use up lower marginal tax rates. That's all well and good. Legislation's thought of this. There is anti-avoidance rules in place which will seek to overturn this type of scenario. For example, pay your spouse a salary from a company. If it's deemed excessive, not bona fide for services provided, the Commissioner can seek to overturn this, treat the excessive amount as a dividend, no deduction to the company. We're suddenly in an inefficient tax position. Similarly, sole trader partnerships moves to, we will disallow the deduction in the sole trader partnerships income tax returns. Again, we're walking down an inefficiency route. If you are one of those sole traders partnerships, don't forget as well that if you are looking to pay a spouse partner a salary, then often you'll have to seek Inland Revenue Commissioner approval before doing so. Accelerate, decelerate. Look, this is the acceleration stuff. The big conversation here is around the acceleration of bonuses to team members, your staff. Inland Revenue in their public statement specifically considered bonuses. If you're doing something with bonuses which changes the contractual nature, i.e. you have a contract that will say that the bonus will be paid on the 20th of April every year, and then you decide to pay it on the 31st of March, look, you've probably got a little bit of an issue there. Other things to think about is if you've changed accounting treatment to accelerate income or decelerate expenditure. Again, the question is, why did you do that? Is it because of the 39% or is there a mitigating factor? Look, I said it wasn't going to be overly positive. It isn't, but going forward, the things to watch for really are penny and hooper, salaries, etc. to spouses. Those are really the absolutely big things that the Commissioner is very concerned about. They have reissued all the revenue alerts, interpretation statements, etc. in that regard to remind us of what they're looking for and how she will apply it. And I think, FBT, sorry, let's end on a positive. FBT, under the new rules, or the new rate, FBT, if you use that single flat rate calculation, it effectively assumes that everybody's a 39% taxpayer. There is the alternate rate that you might want to be thinking about if your employees aren't 39%ers. It is a bit more compliance. It is a process though. If you follow that process, you reduce your bill. So I know there's lots of more negative stuff about FBT, but it's actually really, we're living with 39%. View it as an opportunity to change your processes and how you deal with FBT. I think the last thing I should mention in this regard is Inland Revenue's ability to find. I think while the Inland Revenue isn't God, I think you should assume that they are omnipresent. They will find stuff. It's bad tax advice to say it won't be found, and followed by the foolhardy. So don't be mistaken. Inland Revenue has some fairly grunty tools, data analytics, to find things, and all the new trust disclosures very much highlight new settlements, introduction of new trusts, etc. So just be mindful of that. I think that's all I'm going to say on 39% at this rate, at this point, Ian. So back to you.
Yeah, thanks, Mark. So I'm going to talk about the tax loss carry forward rules, and next slide, please, Christina. I want to take you back to roughly this time last year, and COVID-19 hit and the lockdown happened, and there was an enormous amount of new initiatives that were issued by the government under urgency. Excuse me. And they covered a whole range of things. You'll be very familiar with them: the wage subsidy, the reintroduction of building depreciations, the increase in the low value asset write-off to $5,000, which incidentally applied until assets acquired before 17th of March. So if you bought them on just before 31 March, thinking you're going to get a deduction, you might have to double check that date. They relaxed the research and development refundability, brought in year two's refundability into year one. They increased provisional tax. They went through a whole series of things that were all really business friendly. And the last one to be brought in was the same business test for loss carry forward. At the same time, they'd announced that they would allow a temporary loss carryback if you had incurred a loss in 2020 or 2021. You're allowed to carry back that loss and offset it against taxable income in the prior year. They also announced that it was time to introduce a same business test for loss carry forward, where that same business test is going to be based on the Australian legislation. So why do they need to do that? Why do they need to introduce that? Again, Christina, next slide, please. So the why really, recognizing when companies are in losses, in particular in a startup situation, this sort of really has been a long-standing problem that the 49% continuity test of ownership was too restrictive to allow losses to be carried forward. So a lost company that needed to reorganize, to restructure, that was hungry for capital, and that where that capital was going to come in from new investors and not existing investors, then the 49% rule, which just to recap, allowed you to carry forward tax losses where the same shareholders who were in at the time the losses were incurred were still a shareholder to the extent of 49% at the time the loss could be offset against profit. And if you're introducing a whole lot of new investors, then that continuity of ownership test could easily be broken. And that was an impediment to growth, innovation, and particularly under the COVID urgency, this was going to create roadblocks to lost companies consolidating or reorganizing or restructuring. So the fact that Australia has had a same business test for years and years and years, as well as a continuity of ownership test, it seemed like an easy solution to turn around and say, well, just adopt the Australian legislation or base it on the same business test in Australia and implement it under the COVID urgency provisions. But they had to take some time to develop the legislation, and it was only introduced as a supplementary order paper earlier this year to that ARFR bill that I mentioned at the start. And one of the reasons that it took some time to go through the loss carry forward rules was really about protecting the tax base and ensure that there wouldn't be an opportunity to create no trading for loss companies. So, Christina, next slide. So, Yeah, so and they felt that there was a risk that there would be lost companies that would be in existence that have been sitting around for a while, that would suddenly be bought. There'd be a change of ownership, and they'd argue that the business was going to continue, and that was going to be sort of an anti-avoidance provision. So they looked at the rules in Australia, they looked at the rules in the UK, they looked at rules in Sweden and some other countries, and came up with a business continuity test which is based on no major change. So let's go to the next slide, please. There's quite a lot going on in this slide, and it's about showing that if you have had a change in ownership at a shareholder level, then the losses will not be forfeited, provided there's been no major change in the business activities. Now, because this rule was announced as part of the COVID relief packages, it was to apply from 1 April 2020, or the start of the 2020-2021 income year. And even though the legislation wasn't enacted until the ARFA bill in 30 March 2021, the application date has been backdated to that originally intended date. So that's good news. The question then comes around as to, well, what losses are included in from that date? Does it only apply to losses post 1 April 2020, or does it apply to losses that you have at 2020-2021? So the good news is they've gone allow you to run the business continuity test. And I'm using the term business continuity rather than shareholder continuity, because shareholder continuity will be referring to the 49% test. So the business continuity test will apply to tax losses that were incurred from the 2013-14 income year, so the year ended 31 March 2014 for a March balance date, 31 December 2013 for a December balance date, where there has been a 49% continuity of shareholder continuity change that has occurred after 2020-2021. So you can't turn around and get old losses that you thought had been forfeited before 1 April 2020 under a shareholder continuity and then try and argue they're part of the business continuity. You had to have the shareholder continuity right the way through from 2014 through to 2020-2021. But assuming if you look at the third column, there's a breach that's happened, you know, a lost company desperate for new capital has received an injection of shareholding funds from new investors and has a breach in the shareholder continuity. Those tax losses will not be forfeited, provided the business activity hadn't ceased before the change in continuity had occurred, and that the business activity, there's no major change in that business activity. And this will allow the company to pivot, to innovate, to change direction, if you like, provided there's not a major change in that. And the test will run from a business continuity period on a rolling 5-year basis. So in this case, the breach happened on 1 April 2021. So you'll continue to monitor those losses as they're used up through to 2026, 27, if I've done my 5-year rolling calculation correctly. And that's because the 1 April 2021 is actually in the 2021-22 year. My God, it's confusing, isn't it? So you'll monitor it for those 5 years. Now, if you've still got losses at the end of 27 or at the end of the 5-year rolling period that you haven't utilised, you can still carry them forward. It's just that you don't have to sort of monitor what was the state of your business at that time, because the kind of feeling was that it's very hard to continue to retain an existing business for 5 years just to use up tax losses. You might be incurring costs, spending $1 to save 28 cents type thing. So I think what we've ended up with is a really useful and really workable business continuity test. So let's go into some of the details there. Just next slide, please. So for those who have seen my webinars before, you know I have a penchant for whiskey. So I've given you an example here of the Ian and Mark distillery in New Zealand, which realised assets used to produce the finest botanical gin. And there's a lot of gin distilleries and vodka distilleries around in New Zealand at the moment. But of course, we all know that a gin distillery just really wants to be a whiskey distillery, but they'll get there in the end. So they pivoted. Ian and Mark decided to pivot the business and produce hand sanitizer to meet the demand.
It's a good idea, Ian.
Oh, it's good for cash flow, except that we didn't anticipate that during lockdown, alcohol sales would go up by so much. So we possibly missed out on some increased revenue. So that here there is in the major change test, there is a fundamental requirement that you need to take into account the business assets that are being employed in the business to produce it. So in this case, we are using the same business assets that we used before to change to making hand sanitizer. And so because we're using the same business assets, then that is a really positive thing to saying that our business has continued. Now in that business asset test, be aware that land is not included in that in the definition for those business assets, and that's because land, just in the sheer value of it, could skew the scrum around what was being whether you're still carrying on with that same business. There also and I move to the next slide, please, Christina. The next one is really to highlight that they have also said, look, that we realise that we're bringing this rule in to allow you to innovate and pivot and change your business, but we want to define situations where it's acceptable to have a major change without breaching the loss continuity. And the legislation talks about it here, the increase in if you've made the change to increase the efficiency of your business activity, to take advantages of advances in technology, to pursue an increase in scale or a new market or product or service, or you want to change the type of product or services that you're producing, but you use the same assets or is closely connected with the process, then it will still be okay to carry forward the tax losses. Next slide, please. So let's sort of some examples. Increased efficiency, it might be you make some changes to decrease your costs, advances in technology. You simply, you go from a physical store to an online retailer. You've visited the business. You take into increase in scale. Maybe our botanical hand sanitizer is so successful and the margin's so great that we really become a full-time hand sanitizer. That's fine. That's a new market, and it changes in the productivity, product, service, or type. So there's really, really positive changes you can make to your business without detriment to worrying about whether the losses are forfeited. So next slide. But of course, for every positive change, actually, we'll just go to the next slide. We're running, we won't have time. Just in terms of group companies, there's a couple of provisions in there as well. Remember, a group company can offset a loss in one company can be offset against profit in another company, provided there's a 66% commonality of shareholding. There's no change to those rules. But what there is a change to is that the business continuity allowed the losses to carry forward, but you can still group against the profit company, provided that you've still had that 66% at all times from the time of the loss incurred through to the time of the profit. So if you have a change in shareholder continuity in the loss company and you want to offset it against a profit company, the change in shareholder continuity must also mirror that in the profit company as well to maintain that 66% commonality. The second aspect is if you've got a group of companies and you've got in that group a loss company, then when you're looking at the major change in business activities, they'll look at the group as a whole rather than the individual loss company itself. And I think that's a really positive sign in the group company situation. So again, next slide, please. So there are specific anti-avoidance measures, as you would imagine, and then this is one of the things that they really wanted to make sure that the tax base was protected. So in particular, they didn't want a whole bunch of dormant companies that had been sitting around for years with losses suddenly being reactivated and then sold. And so this was aimed at making sure the company didn't have to be totally dormant. It just could be very inactive, if you like, and where there's very little value left in that dormant company other than their tax losses. So in that situation, if there is a sale of shares purely for the purpose of using those losses, then that won't be successful, and the anti-avoidance provisions can apply. Also, there's provisions around, hang on a minute, I want to change my business activity. I've got an agreement I'm looking to sell it to a purchaser. He wants me or she wants me to change that business. Then I'll start to change the business beforehand while I've still got shareholder continuity, and then I sell the business maybe in a year's time or 6 months' time, and I argue that my business really hasn't changed because I'm applying it at that date. So you've got to work through the anti-avoidance provisions in there as well, and a specific anti-injection rule post a change in continuity where you're looking to inject income into a lost company from another source which is outside of the business activity. It might not meet the major change, but you've deliberately gone about this in a way with an associated person in order to sort of inject income into a lost company after a change in continuity. Now, that doesn't mean it's been a common practice when you've had losses in a company to inject an asset into the company to generate income to recover the losses that have been made, and that can apply where there's no change in continuity, where there's because you've satisfied the shareholder continuity. The business continuity test is there where there's been a change in continuity for shares. So we have an example next of this anti-injection rule. Christina, if the next slide, please. So Moody Blue Boats Limited is a failing manufacturer of fish finding equipment for boats. It sustained significant losses, etc. And Midnight, who has some song licenses and income, acquires Moody Blues and then looks to inject the song license in there. And if there's an associate person at the time the arrangement was entered into, then the anti-injection rules will apply. So finally, what does the loss carry forward mean to you? Well, it's about, again, Christina, next slide, please. We just recommend keeping records of your major changes in business that happen. It doesn't need to be an overly onerous task to do that, but if you're trying to have an argument with the Inland Revenue in the future over whether you've had a change in business or not, then you want to have some records to fall back on. And that can be through board papers and when each time there's a major change. I would age your tax losses to obviously prove that they're post 2013, 2014, and keep monitoring them as you go through, both for the rolling 5-year period subsequent to that. Then finally, just remember, this is about a change in continuity shareholding, which happens from the start of the 2020-21 income year, but there's been no major change in your business. So I'm sorry that sounded a bit rushed, but I'll now pass over to Mark on the residential properties.
Thanks, Ian. You can have confidence in everything we say, but in particular, Ian was on the team that helped write and develop these rules, so he knows what he's talking about with these tax loss carry forward changes. Bright line. Okay, this is a really powerful slide. We have an arrow going straight through the heart of an apple. It doesn't matter what you say. Bright line. You can say it's not a capital gains tax. It quite definitely is a capital gains tax. Now, I have to admit that when Grant Robertson signalled earlier this year there were going to be some bold changes to curb demand in the housing sector, I was academically excited. Not so much given it was a 5 to a 10 year bright line test, but I guess the reason was to make purchases of residential property less attractive. It's gonna remove the tax shields, or largely remove a lot of the tax advantages, again making it less attractive and helping that first-time home buyer out. So just recapping our bright line. Our bright line is or has extended from a 5 to a 10-year rule for residential property acquired on or after the 27th of March 21. Just remember, new builds, we'll come to that at the end of this slide. New builds have been carved out. Now, there was a flurry of activity up to the 27th of March 21, and we're all high-fiving that we managed to get into a 5-year rather than a 10-year rule. One of the things that we had to think about was date of acquisition. The date of acquisition, for the purposes of determining which bright line test you are under, is a reference to a binding agreement, which can be subject to some conditions such as financing clauses or insurance clauses. There was a separate rule that applied for tenders in progress. For example, a purchaser offered a property up for tender that they couldn't retract, but the tender or agreement happened post. You could still fall within a 5-year test as long as it was offered up before the 27th of as long as the person had put their tender in before the 27th of March 21. One of the big things to watch for, it's an easy trap, is nominees. So you set up your sale and purchase agreement, it's Ian and or nominee, and then after the 27th of March or on the 27th of March, Ian introduces or nominates his trust to acquire the property. The trust will be subject to a 10-year rule, even though the binding agreement happened prior to the 27th of March, because that nominated person did not have their first interest in the land until after the 27th of March. So just be really careful with nominations and making sure you're working within the right rules. New builds. So new builds, as of yet, is undefined, working through a consultation period with respect to defining a new build, but the rules are that new builds are excluded from a 10-year rule, a 5-year rule would still apply. Clearly, this is a move to make sure that we are focusing on supply and not inadvertently distorting or trying to improve the supply of new builds. Next slide, please, Christina. So this is quite a busy slide, but it just highlights how we've evolved from not having a bright line test to getting used to a 2-year to suddenly having a 5-year rule and now a 10-year bright line rule. And it's the date of acquisition that's really important here. So 1st of October 2015, acquisitions post this, subject to a 2-year bright line. From the 29th of March 2018, we moved to a 5-year. And again, at the time, I recall that was a very quick introduction as well. Residential property acquired on or after the 27th of March, we are moving to, or we are in that 10-year bright line rule. The thing to watch for here is you just need to remember that we do have a 5 and a 10-year rule running concurrently. Different parts of the legislation, just be focusing on when the property was acquired and you'll be fine. In terms of the clock starting to tick, you might be subject to a 5-year, but the 5 years doesn't start ticking until title has been received, normally on settlement. We receive a lot of questions around subdivisions. So I've owned land for ages and I'm now going to subdivide it. How does that impact on my bright line? The bright line rules will apply to the pre-subdivided land. So you're not resetting a clock in that regard. Off the plan acquisitions, we've changed the clock on that one as well, and it tends to apply from the date of acquisition rather than a settlement or issue of title. But it's just highlighting that we do have all these things running concurrently now. Creates a bit more nice confusion. Christina, next slide, please. So the modification of the main home exemption. Now, this used to be an all or nothing test, and New Zealand tends to operate in congruence with a your home is your castle test for tax, i.e. you can't be taxed on your main home. Now, as long as you're under the old rules, as long as you predominantly used the property, the residential property as your main home, i.e. more than 50% occupation, all or nothing, it's all excluded. The new rule amends this, and now we look at periods of use that where it was not occupied as the main home, and that would include times when the property was left vacant. The rule change applies on a go-forward basis. It's still from that acquisitions of the main home from the 27th of March. Effectively, all it does is it looks at the capital gain and it apportions it between the period for which you occupied the home as your main home, you're living in it, against the period that it was left vacant. It's a pro rata. So the amount of gain that would be taxable would be a reference to total non-use over total use times capital gain, which I think is in the next slide. One of the things that we need to remember with the main home exclusion, though, and it was for the old rule as well, that it is possible to effectively have more than one main home. The new rules will, regardless of what the home was used for, will give you a 1-year buffer. So provided the home is not used for more than 365 days other than for any other use, then you effectively ignore that 365 days or less in the calculation, and it's deemed to be used as your main home. So if it's vacant because you've gone on holiday for an extended period of time or anything like that, it might well be that you've moved out before you sold, or it might well be that you bought before you could move in for various reasons, i.e. settlement dates delayed, etc. As long as it's less than 365 days, that non-use period, ignore that when you're doing the main home exemption pro rata calculation. Next slide, please, Christina. This is just a question around the main home. You can read that at your leisure. It's effectively what I've just said. A couple of things that we just need to remember with that main home exclusion is that don't think you can use it again and again and again and again. It doesn't work like that. You can only use it twice in any 2-year period. And if you establish a pattern or frequency of using a main home exclusion, you'll find that main home exclusion is effectively removed. There's also some new specific anti-avoidance provisions where you may seek to say, oh, well, my husband owns the main home, then I'll own the main home, and then the trust owns the main home. And they've all sold within that 2-year period. It'll all be combined together in working out whether or not you've done 2 or more in that 2-year period. So just be mindful of that. Next slide, please, Christina. I think we can whip through the answer as well there. And again, please. Lots and lots of questions on short stay accommodation. Does Bright Line apply to Airbnb, or do we get the business premises exclusion? Now, people are applying it differently depending on your appetite to risk. We've now had an amendment to our definition such that it clarifies Airbnb accommodation, so such that it's short-term accommodation offered through the internet would be subject to a bright line. It was never envisaged that such residential property wouldn't be caught by bright line. However, the way the definitions worked, it was sufficiently grey for arguments to be presented that the business premises exclusion would apply. The definition has been amended. The rule change applies on a go-forward basis, and the Inland Revenue has conceded that, look, there is some uncertainty with the past on the basis that the definition is a go-forward, not a retrospective change, and therefore the argument still presents. And I guess in terms of how you apply Airbnb accommodation, again, it's a question for the past. Again, it's attitude to risk and extent of business activities. Next slide, please. Interest deductibility. Lots of discussions around interest deductibility. We don't have legislation at the moment, but the way it's headed is that interest deductions are going to be removed for residential property. Again, new builds excluded from the limitation. The lack of deductibility will be phased in over a 4-year period, commencing the 1st of October 21. So year 1, 100% deduction, 75, 50%, 25%, down to 0 to give everyone a chance to get used to it. This one in particular made a lot of tax people cry, very upset that it's got that it's completely alien to how the tax legislation works, very unfair. And I think Ian's going to briefly mention that in a minute. Next slide, please, Christina. Just before I hand over to Ian, I just want to make it very, very clear that the bright line test is not a safe harbour threshold to mitigate any tax on land taxing provisions. We have really, really widely drafted provisions. These rules were effectively brought in to act as a support for the rule that referred to property acquired with the intentional purpose of resale. That still stands. We still have that rule. Please, please don't be confused into thinking I can wait 10 years, then sell and not be taxed. There are other rules that may capture you. There are lots and lots of things to talk about bright line, but in the interest of time, I will pass over to Ian to talk about budget 21.
Thanks, Mark. Look, I know that we're running out of time, and there's been a couple of questions that have come in so far, so I'll just quickly deal with 2 of those questions and then touch base on the budget. So the first question is, if you have a change in shareholder and breach the shareholder 49% continuity test in 2021, losses prior to 1314 are lost. And that is correct. They would be lost. And the reason I think they went back a certain level because to 1314, but they didn't want to go back to 2010, 2011 in case there was a whole lot of GFC type losses that had been incurred perhaps through finance companies or whatever. So they just thought it was a reasonable basis to start at 1314 in order for those losses. So you're quite correct that if you've had a change in continuity, the losses prior to 2013 and 14 are lost. No business continuity applies. Losses subsequent to 13 and 14 can be carried forward. Then there's another question which says, I'm thinking about employing a CEO to take over certain elements of my role. As a result, I would reduce my salary. Could this be viewed as avoidance? Look, I'm probably take a slightly more aggressive view than some people, and I think that the principle of choice within a business is absolutely paramount, that you should be allowed to do things with a view that reflect your market and reflect your role, and that this wouldn't be viewed as avoidance. And you would be able to reduce your salary because your functions and your role has clearly been reduced. And if we go back to the Penny and Hooper example, it's about paying a market value for your salary. So if you're stepping away from the business and your obligations, functions, and duties are changing, then that's perfectly acceptable to reduce the salary to reflect that. And so I don't think that should be viewed as avoidance at all. I think obviously there's a requirement to document those changes and what's being made, and of course, and the change in the role, whether it's through employment agreements or whether it's through board minutes, etc. You need to have that basis for there to do that. So, of course, if you reduce it down to 70,000 or 179,999, it might look a bit smelly.
I'm the same with Ian on that, Penny. I really struggle with it. It seems to be, Inland Revenue is quite clear that Penny and Hooper isn't necessarily a reflection of market value salary. They're looking at that 80% distribution scenario, which seems to be contrary, that if you run with the market and are commercial, then there should be no wrong. And I think that's just horribly unfair. But I completely agree with Ian. I don't think it's avoidance if you've brought someone in to do a lot of your job, and you're not rolling your sleeves up as much, then you shouldn't get paid as much. That's fair enough. Sorry, Ian.
Yeah, that's okay. There's one other question, Mark. Do you want to have a look at that while I just quickly have a look at budget 2021? Okay.
Sorry, I should have clarified the interest thing up front. That the interest phase out is for property that you already owned. For new property after the 27th or on or after 27th of March, there is no interest deductions or proposed no interest deductions. And so one of the questions is if an owner-occupied property purchased pre-27 March is changed to a rental post-27th of March, will the property be treated as the same as those purchased pre-27 March 21 and allowed the phasing out of interest deductibility? We don't have legislation at the moment, but on the basis that the legislation is all focused around when property was acquired as opposed to the change of use type scenario, I would suggest that the interest deductibility would still be permitted as if, well, not as if, factually, it was acquired pre-27 March. So I would have thought that would be fine in terms of phasing out.
Yeah. And I think, Mark, you make a good point there that the announcements on the interest deductions and the new build provisions, there have been no details and no legislation as to how they'll be introduced yet. So there's still a way to go, and maybe that will be included in budget 2021. So that budget day is set for the 20th of May. BDO will be covering that in our normal fashion with a rapid summary, short summary. And if I guess the days have passed since we've had a lot of tax announcements made at budget time. They tend to happen as we go through the year. Some of the things I'd like to see them, and these are personal thoughts, is, we need to try and change the way in which we're approaching housing, and the tax things I think are a blunt tool, and frankly I don't have a principle basis in terms of that 10-year bright line. National brought it in to stop having an argument around whether I bought a property with the intention of resale when I flicked it on within 2 years. It removed that argument. Going to 5 years was kind of okay. Going to 10 years is who knows what you were planning to do in 10 years' time when you bought it. So it's an absolute tax grab. And I think if it's be careful what you wish for, maybe we should overhaul the land transaction rules. I'd like to see the interest deductibility reversed, because I think it's just as a matter of principle in the tax system. Why can you have one deduction for one business but not for another business, etc. But look, housing is a problem in lots of countries, and they've got to find a way of tackling it. Next slide, please, Christina. Just quickly,
Ian, can I just jump on
sure.
some of the things like GST? I know that countries around the world have a far higher GST threshold than us. For example, the UK sits at £85,000 sterling. Quite significantly higher than our one. The one area that I do worry about is that Airbnb type scenario, and people inadvertently tipping over the GST threshold and bringing that property into the GST net other than was intended. It just seems to be a bit unfair to me that the threshold is so low relative to that type of activity, especially if you have more than one or many Airbnbs, that perhaps that we should have something a bit higher in that regard. The other big thing for me is around, we talk a lot around digitizing things, making tax simple and having a digitized tax return process. I'm really struggling to see how we can get to that if we've got simple things like a very, very complicated depreciation regime that refers to any number of assets, any number of industries, and works through the estimated useful life. And we have to go through and find the right rate for each and every single one. Why can't we move to more of a system that has a flat rate DV value for depreciating assets? Yeah. Sorry, Ian, back to you.
No, I think we're just about to run out of time, so I don't know whether we'll get cut off or not. So Mark, just thank you everybody for your attendance at the conference. Look out for the budget day release on the 20th of May. We will have another Rethink seminar coming up. Mark, you've got the date?
Yeah, that's on the 20th. That's on the 20th of May, 8:30 to 9:30. So non-tax people clearly get up earlier than us. And the topic is on community governance, investment and impact, focusing on 3 big issues in the social profit, public benefit sector. We also got Grant Robertson joining us in July for a conversation on post-budget and looking at some of those macroeconomic issues. So there's more to come. Thank you again, as Ian said. Apologies, we had an awful lot of information to go through today. If you have any questions, contact myself, Ian, any of your friendly BDO advisors. We're happy to help, team.
Yeah, thanks again, and have a great day, and we'll look forward to catching up with you again on another Rethink webinar. Thank you.
Thanks, guys.